Welcome back to CMA USA Exam Coach. It's great to see you again. In the last episode, we introduced the balance sheet and looked at all the key items that appear in it: assets, liabilities, and equity. We learned how a balance sheet shows the financial position of a business at a specific point in time. Today, we're moving to the next major financial statement, the income statement. The income statement tells us something very different compared to the balance sheet. Instead of showing what a company owns and owes, the income statement shows how much profit or loss a company made over a period of time, like a month, a quarter, or a year. So in simple words, balance sheet equals to the financial position at a point in time. Income statement equals to financial performance over a period of time. By the end of this lesson, you will clearly understand what revenue, expenses, and net income are, and why the income statement is so important for investors, managers, and lenders. All right, let's begin and make this concept crystal clear.
Let's begin by understanding what an income statement actually is. The income statement, also known as the profit and loss statement, tells us how much money a business earned and how much it spent during a specific period, like 1 month, 1 quarter, or 1 year. So instead of showing what a company owns and owes, like the balance sheet, this statement shows performance, whether the company made a profit or suffered a loss. Think of it like a movie, not a photo. It shows the company's financial story over time: revenue coming in, expenses going out, and finally, the net result: profit or loss. The formula behind it is very simple. Revenue minus expenses equals net income. If revenue is higher than expenses, great, the company earns a profit. If expenses are higher, then there is a loss. The income statement helps investors, managers, and lenders see how efficiently a company is operating. It answers important questions like: is the business making money? Are costs under control? Is profit growing or declining? Now that we know the meaning and purpose, in the next slide, we will look at a sample real-world income statement and understand each item step by step. On this slide, we have a traditional version of the income statement, often referred to as a trading and profit and loss statement. Let's break it down. On the left-hand side, we list all the expenses and costs that the business incurs to run its operations. It starts with the opening stock, which represents the inventory we have at the beginning of the period. Then we have purchases, adjusted for any purchase returns, showing what we actually bought to sell. Next come the direct expenses, like wages paid to workers and freight charges for transporting goods. After deducting all these from the sales, we arrive at the gross profit, which essentially tells us the profit earned from the core trading activities before considering other operational costs. Below gross profit, we list indirect expenses, which include salary for administrative staff, rent for premises, electricity bills, and other bills. These are costs necessary for running the business, but not directly linked to production or purchase of goods. After accounting for these, we finally arrive at the net profit, the true profit of the business after all expenses. On the right-hand side, we have income sources. It starts with sales, adjusted for any sales returns. Then we include closing stock, which is the inventory left unsold at the end of the period. We also account for indirect income, which includes items like commission received, rent received, and discount received. These are additional incomes not directly from sales, but still part of the business earnings. So, this traditional format helps us visualize both the costs incurred and the revenues earned, giving a clear picture of how the business generates profit, even though no numerical figures are shown here. This slide is purely a sample presentation to help you understand the structure and flow of a classic income statement. Let's now look into the modern presentation of income statements. In the sample shown, you can see how the income statement is arranged. On the left side, we have details for the last quarter, meaning July, August, and September 2025, compared to the same quarter in 2024. On the right side, we have the 9-month income statement, which aggregates the period January to September 2025, again compared with the same 9 months of 2024. Income statements are always presented with a comparison to the previous year to help understand performance trends over time. This structure allows us to see both short-term quarterly performance and cumulative performance for the year. On this slide, we have a real-world example of an income statement from ADNOC, a UAE-based oil distribution company. Let's summarize the key figures for the 9 months ended 30th September 2025. We start with revenue, which amounts to 26,437,126 AED. From this, we deduct direct costs, also known as cost of goods sold, totaling 21,342,009 AED. After this deduction, we arrive at the gross profit of 5,095,117 AED, which represents the profit from core operations before considering other expenses. Next, we subtract distribution and administrative expenses, which amount to 2,436,643 AED, and add other income of 96,187 AED. After accounting for impairment losses and other operating expenses of 82,383 AED, the company achieves an operating profit of 2,672,278 AED. We then consider interest income, which is 54,272 AED, and finance costs of 311,176 AED, arriving at a profit before tax of 2,415,374 AED. After deducting income tax expense of 248,093 AED, the company reports a net profit for the period of 2,167,281 AED. This profit is further split between equity holders of the company, who receive 2,126,189 AED, and non-controlling interests, which account for 41,092 AED. This example gives a clear picture of how a modern income statement is structured, showing revenue, costs, expenses, and finally the profit both before and after tax, with detailed breakdowns of what the business earns and spends over the period. Now, let's dive a little deeper into income statements. There are two main formats that companies commonly use. The first is the single-step income statement. As the name suggests, it's simple and straightforward. It groups all revenues together, all expenses together, and then calculates the net profit by subtracting total expenses from total revenues in a single step. The second is the multiple-step income statement. This one is a bit more detailed, as it separates operating activities from non-operating activities and shows subtotals like gross profit and operating profit before arriving at net income. Both formats ultimately give the same bottom-line profit, but the multiple-step format provides more insight into where the revenues and expenses are coming from. We'll explore detailed examples of both formats in the next slide. Now, let's look at the single-step income statement in detail. As we discussed, this format is very straightforward. On the top, we list all sources of revenue. For example, we have net sales, dividend received, commission received, rent received, and profit from the sale of fixed assets. When we add all these, we get the total revenue, which is shown here as 300. Next, we move to expenses. This includes cost of goods sold, selling expenses, administrative expenses, interest paid, and taxes. Adding all these gives us the total expenses, which is 330 in this example. Finally, we calculate net income by simply subtracting the total expenses from total revenue. This is why it's called a single-step statement. There is just one calculation to arrive at profit. Even though it's simple, it gives a clear picture of the company's profitability in a very concise way. Now, let's explore the multiple-step income statement. Unlike the single-step format, this one breaks down the income and expenses into multiple layers to give more insight into the company's performance. We start with revenue, just like before. Then we deduct cost of goods sold, which gives us the gross profit. This step highlights how efficiently the company is producing or purchasing its goods. Next, we subtract selling and administrative expenses to arrive at operating income, showing the profit from the company's core operations. After this, we add any dividend or interest income to calculate EBIT, which stands for Earnings Before Interest and Taxes. From EBIT, we subtract interest expenses to get EBT, or Earnings Before Tax, for continuing operations. Then we account for provision for income tax, which gives us income from continuing operations. If the company has any discontinued operations, we include gains or losses from those, after adjusting for any related tax effects. Finally, combining continuing and discontinued operations gives us the net income, which is the ultimate bottom line. This format is more detailed, allowing stakeholders to see exactly where profits are coming from and where expenses are being incurred, making it very useful for analysis and decision-making. The income statement is a financial report that shows the performance of a company over a period of time. It could be a month, a quarter, or a year. You can think of it like a movie, where you watch the company's operations unfold over time. Every revenue earned and every expense incurred during this period is recorded, so you can see how much the company earned and how much it spent. This is different from the balance sheet, which is more like a photograph. A balance sheet shows the financial position of a company at a single point in time, like the exact snapshot of assets, liabilities, and equity on December 31st. The income statement, in contrast, is dynamic. It tells a story of how the company earned money, spent money, and finally made a profit or loss during the period. The income statement is very important for several reasons. It helps investors and management predict future cash flows. By looking at revenue trends, expense patterns, and profit margins, you can estimate how much money the company may generate in the future and when it will likely come in. It helps assess the operating efficiency of the business, such as how well the company is controlling costs relative to its revenue. It provides information to make important decisions, like expanding operations, investing in new projects, or reducing expenses. The income statement is prepared using the accrual method of accounting, which means revenue is recorded when it is earned, not necessarily when cash is received. Expenses are recorded when they are incurred, not necessarily when they are paid. This gives a more accurate picture of the company's performance than just looking at cash flows. Now, the income statement has two main categories. Income from continuing operations. This includes all revenues and expenses from the parts of the business that are expected to continue operating in the future. It includes operating revenues, like sales of goods or services. It includes operating expenses, like cost of goods sold, salaries, rent, and utilities. It also includes non-operating income or expenses, such as interest earned on investments, gains or losses from selling assets, and financial expenses like interest paid on loans. Finally, it accounts for income tax on these continuing operations. Think of this as the core story of the business, the activities that are ongoing and will affect future profits. Income from discontinued operations. Sometimes a company may sell or shut down a part of its business. This could be a major product line, a factory, a branch in another country, or a significant investment. This is called a discontinued operation because it represents a strategic shift and will not continue in the future. All gains or losses from these discontinued operations are reported separately, after tax, so that users of the financial statements can see the impact without confusing it with normal ongoing operations. For example, if a company sells its electronics division at a profit, that profit is included in discontinued operations. Similarly, if there is a loss from closing a factory, that loss is shown here. By separating these, stakeholders can clearly understand which profits came from normal business activities and which came from one-time or strategic decisions. In simple terms, the income statement tells the full story of a company's financial performance, showing both the results of ongoing operations and any special, non-recurring events that affect profit. For a new student, imagine it like this. Continuing operations equals the regular scenes in the movie that happen every day. Discontinued operations equals special, dramatic scenes that happen once, like a major factory closure or sale of a business unit. Both parts are important to understand, but separating them makes it easier to analyze the true performance and sustainability of the business. Now, let's discuss the key elements of the income statement, which are revenues, expenses, gains, and losses. Understanding these is essential because they tell us how a company earns money, spends money, and how certain transactions affect overall equity. Revenues. Revenue is the income a company earns from its main business activities, like selling goods or providing services. Under ASC 606, revenue is recognized in the period when the company satisfies its performance obligation, meaning the customer obtains control of the good or service. For example, if a company sells a smartphone, revenue is recorded when the customer receives the phone, not necessarily when payment is received. Similarly, if a consulting firm provides services to a client, revenue is recognized once the service is completed and delivered. Revenue is the primary source of income for the business, and it is central to understanding profitability. Expenses. Expenses are the outflows of cash or other resources, or the using up of assets to earn revenue. They are costs incurred as part of running the business. For example, if a company manufactures chairs, expenses would include raw materials, salaries of workers, electricity, and rent for the factory. Another example is a software company paying for cloud services or employee salaries. These are necessary to generate revenue. Expenses reduce the company's profit and are subtracted from revenue to calculate net income. Gains are increases in equity from transactions that are not part of the company's core operations. They are not earned through normal business activities, but still add to the company's overall financial position. For example, if a company sells a piece of land or equipment for more than its book value, the profit from the sale is a gain, not revenue. Another example is selling an investment or shares in another company at a profit. Gains are reported separately to show that they are non-operating or one-time in nature. Losses. Losses are the opposite of gains. They are decreases in equity from transactions that are not part of the business's primary operations. For instance, if the company sells a machine for less than its book value, the resulting negative difference is a loss. Similarly, losses can come from natural disasters, lawsuits, or disposal of assets not related to normal business. It's important to note that losses and gains are not part of normal revenue and expenses, but they affect overall profitability and equity. In simple terms, think of it this way: revenue and expenses equal day-to-day operations, what the company is primarily in business to do. Gains and losses equal one-time or non-core transactions that still affect the bottom line. For example, selling products at a profit generates revenue. Paying rent or salaries are expenses. Selling old machinery at a profit is a gain, and selling it at a loss is a loss. Next, let's talk about other income statement items, specifically unusual gains or losses. These are gains or losses that are not expected to happen regularly and are infrequent in nature. They are different from normal operating revenues or expenses because they arise from unusual events. For example, losses on inventory. This could happen if inventory becomes obsolete, damaged, or spoiled. It is not part of the company's regular operations, but still reduces profit. Damage from fire or natural disasters. If a factory is damaged due to fire or flood, the loss is significant but unusual. Restructuring charges. Sometimes companies reorganize their operations, close certain departments, or reduce staff. The costs associated with these changes are one-time and unusual, not part of daily operations. Even though these items are unusual, they are generally reported as non-operating gains or losses within income from continuing operations. This means they are included in the ongoing operations section of the income statement, but are clearly separately identified so that users can distinguish regular performance from extraordinary events. In simple terms, think of it like this. If the income statement is a movie of the company's operations, Unusual gains or losses are special scenes that happen rarely. They affect the overall story, but are not part of the daily script. Now let's discuss discontinued operations, which is an important concept in the income statement. Discontinued operations occur when a company stops or disposes of a part of its business that represents a strategic shift and will have a major effect on operations and financial results. For an operation to be classified as discontinued, at least one of the following three criteria must be met. Held for sale. The component or group of components meets the criteria in ASC 205-20-45-1E to be classified as held for sale. This means the company has decided to sell that part of the business. It is available for immediate sale, and the sale is highly probable. Sold, the component or group of components is actually sold. Once the sale is complete, all the gains or losses from the sale are reported as discontinued operations, separate from continuing operations. Disposed of in another way. Sometimes the component is disposed of without a sale, such as through abandonment, shutting down operations permanently, or distribution to owners in a spin-off. Even though no cash is received, the financial impact is still reported in discontinued operations. The key idea is that discontinued operations are separate from ongoing business. By reporting them separately, the income statement allows investors and management to see the effects of strategic decisions without confusing them with regular business performance. In simple terms, think of it like this. If the company is a movie, discontinued operations are scenes from a subplot that the company is removing entirely. They are important for the story, but they are no longer part of the main plot going forward. Let's now look at the benefits of the income statement. First, the income statement helps users compare performance. By looking at revenue, expenses, and profits over multiple periods, you can see whether the company is growing, stable, or declining. It also allows comparison with other companies in the same industry to understand relative performance. Second, it helps assess risk and uncertainty of future cash flows. By analyzing trends in revenue, costs, and profitability, stakeholders can estimate how much cash the company is likely to generate in the future and how reliable those cash flows might be. This is especially useful for investors, lenders, and management when making financial decisions. However, there are also limitations to the income statement. Accounting methods affect reported income. The net income reported can vary depending on the accounting choices a company makes. For example, using different depreciation methods for assets can create significant differences in profit, even if cash flow remains the same. Qualitative factors are not included. The income statement focuses only on numbers, so it doesn't show important qualitative information like customer satisfaction, brand strength, employee expertise, or market conditions, which can also affect a company's performance. In short, while the income statement is a powerful tool to measure financial performance, it should always be analyzed along with other information, such as the balance sheet, cash flow statement, and qualitative factors, to get a complete picture of a company's health.
Dear students, great job completing this session. Today we introduced the income statement, one of the most important financial reports in accounting. If something feels new or a bit confusing, don't worry at all. This episode was just to help you understand the basic structure and purpose of the income statement. In the upcoming lessons, we will go through every section and every term in detail, step by step, so everything becomes easy and clear for you. For now, try to review real-world income statements, look at the different items, and notice how companies report their revenues and expenses. This practice will slowly build your confidence. Thank you for learning with us. Keep practicing, keep growing, and I'll see you in the next episode. Take care and keep learning. Bye!